All right. Hello, hello, hello. Welcome to FinServ Now. I am your host, Zakiya Larry. And thank you so much for being flexible with us today. But thank you for being open to adjusting in what folks are calling the new normal. And not just adjusting, but thriving. And so that's what you will get from this series of speaking to the brightest minds in this industry. So I am so excited to welcome you. And speaking of the brightest minds in this industry, you all are here because you know we are talking to Rick Sharga today. So let me tell you a little bit about him. And guys, we're going to jump into a very compelling discussion. So Rick Sharga is the founder of CJ Patrick Company, a consulting firm that helps real estate, financial services, and technology companies develop a position of competitive advantage and use it to drive business strategy, marketing, and sales. Rick is also a founding member of the Five-Star National Mortgage Servicing Association. Hi, Rick.
Good afternoon.
Good afternoon. So, hey, your bio is just a sneak peek, but I think you are going to really open up your world to us today, right?
Absolutely.
Yes, I'm excited about that. So, Rick, people are here because we have promised them that we're going to talk real estate market outlook and specifically foreclosure forecasting in the era of COVID. But before we really drill down into the forecasting when it comes to foreclosures, I'd love for us to take a step back and let's first give people that sort of eagle's eye view. Let's look at the umbrella first and touch on the market in general. I'd love for you, if you don't mind, to share with us your thoughts on May numbers as it relates to buying, selling, the health of the market right now. Because, hey, the reports are saying the numbers are bad, but have we reached the bottom?
Well, the reports are right. The numbers were dreadful. I think we were down almost 10% from April, and April was way off compared to last year. But the numbers are awful, and they're not surprising. We basically told everybody to stay home. We told realtors to stop selling houses, and that's precisely what happened. What's actually kind of gratifying is that there were any homes sold at all during the month of May, because typically people would have been out looking for those homes in March and April and closing on them. And so there's nothing that we're looking at right now, whether it's unemployment numbers, whether it's continuing claims for unemployment, whether it's home sales, that's terribly surprising. It's all a little bit dismal, but it is about what we would expect. The good news is all signs are pointing toward the beginning of a recovery in housing. We saw listing volume drop off a cliff. It started to come back almost immediately as each market begins to reopen its economy. We've seen the same thing on pending sales. In fact, pending sales had a near record level increase. So, the hope is that June numbers will improve, and personally, I believe we're going to see a very strong summer selling season. One other data point that suggests that could be the case is we've seen, I believe now, 6 consecutive weeks of higher and higher mortgage purchase applications. In fact, we're running ahead of last year's numbers at this point. So there's a lot of buying interest, a lot of pent-up demand. I believe the summer season will be very strong once people are able to get out and look at houses and buy them again. My only question really is whether, excuse me, it's going to be a one-time burst of activity because of all the pent-up demand, or it's something that will be sustained throughout the rest of the year. But housing in general, I'm hoping has bottomed out, and we'll start to see the numbers improve over the summer.
You made an interesting point, Rick, about the pent-up demand, and this could be an influx. So before we move forward in the conversation, I'd love for you to unpack for us really quickly, what can servicers as well as real estate professionals do right now to start to prep themselves for any potential influx? Do you think there's anything specific that they need to do right now?
Well, realtors need to make sure people remember who they are when it's time for them to start buying houses again.
Oh yeah.
If you look at the traffic going to the real estate portals, that's my new copyrighted term for traffic on portals. It's traffle. It's copyrighted, so don't use it.
You know what? I love that.
But anyway, home search traffic is higher than it was a year ago. Again, listing volume is starting to come back, although inventory is still weak. One of the things I've been telling realtors during the pandemic is that during a downturn is really the best time to stay visible, because in every industry I've ever been involved in, and I've been involved in quite a few different industries, the companies, the brands, the people that maintain visibility during the downturn are always the ones who gain market share as the economy recovers. So right now is a really good time for realtors to be making their presence known. You can do it a lot more cheaply today than ever, just using things like social media,
Right.
and make sure that as people are getting ready to buy and sell, you're top of mind. The lending industry, it's not so much a servicer issue yet in terms of the volume of sales. That's a pretty straightforward process, and the servicers are probably adequately staffed to handle that kind of volume. Um, the front end of the process, the lending, is where you might have some issues, because we also have a flood of refi activity coming in because the interest rates are historically low. So
Mm.
I know lenders are desperately trying to hire loan officers and underwriters and loan processors, and so the front end is all good news. It's all buying activity. We have millions of millennials who are between 26 and 32, and the average first-time home buying age right now is 33. So the demographics are just suggesting we have a bunch of people getting ready to buy. We also anecdotally know there's a bunch of people trying to move out of small places in urban areas, into bigger homes in the suburbs, because they realize that getting locked in a 700 square foot apartment for 3 months really wasn't that much fun. Um,
Right.
so there are some demographic and societal trends that suggest we should be seeing a lot of home buying activity, and people just need to be ready for it.
Absolutely. Absolutely. Thank you for that. So let's then shift and go deeper into some details about the market that servicers and certainly customers might be overlooking. That's what I love about you, Rick. You really peel back the layers here. So when it comes to the market, you're a bit bullish about it, right? We had that conversation. Can you tell me why?
Yeah, I'm actually very bullish on
Mm.
how we come out of this market. So there's a couple things. One, I've done some fairly extensive research. Be happy to share the white paper with your listeners if they're interested. And I say listeners because our video isn't working today. But
Absolutely.
I've taken a look at the housing market during prior pandemics, and I've gone through about 20 years of data from First American Data Tree. And what I found is that historically, housing performs better than the overall economy through and after pandemics and economic shocks like 9/11. So if you look back historically at prior pandemics, at economic shocks, at recessions, it was very often housing that led the way out of those bad economic periods and helped the economy get back on its feet. That's one reason to believe that we can be hopeful to see something like that again this time. A lot of people are concerned that we're going to see a tsunami of foreclosures, and that's certainly
Mhm.
something that I know your clientele is interested in trying to figure out, in terms of how to prepare and what to expect. I don't believe we're going to see that for a few reasons. Um, One is that, first of all, the number of people in the forbearance programs is way below what the gloom and doom people were forecasting. We had some people suggesting 25-30% of borrowers would be in the forbearance programs, and in fact, the Mortgage Bankers Association announced today that the number has actually gone down from a week ago. We're below 8.5%. So that's still 4 million plus people in the forbearance program.
Mhm.
But it's nowhere near the number that the worst case scenario had projected. We'd have to actually triple the number of people in the program to get to that worst case scenario. Um,
So,
Secondly,
Rick,
yeah,
before you go into secondly, I want the audience to breathe with that for a bit, because I think what you're doing is you are not only giving incredible insight, but you're helping folks to grab a little hope here, right?
yeah.
Because you're adding incredible perspective. So, just to reiterate, the numbers would have to triple to even meet projections, right?
So
So, you're
you,
saying we're in a good spot.
we're in a good spot, and it might actually be better than it looks. Again, there's between 4 and 4.5 million borrowers in forbearance. If all of them were in financial distress, if all of them were on the verge of default, this would be a real concern. But
Right.
again, the numbers don't support that. Lending Tree did a survey, and survey data, never sure exactly how accurate it is, but it's research. And they suggested that between 70 and 80% of the people in the forbearance program didn't really need to be in the forbearance program, but are more or less hedging their bets. So they enrolled in the program just in case their financial position got bad, or just in case they did run into hard times in terms of paying their mortgages, sort of better safe than sorry. And we actually saw about 40% of the borrowers in the forbearance programs make payments in April, the first month of the program. We saw about 22% make payments in May, and it was 22% of a larger number because more people were in the program. And Black Knight reported, I believe just yesterday, that they saw a higher percentage of people making payments in June than they saw in May. So a lot of the people that are in the program are continuing to make payments. A lot of them may or may not really need to be in that program. And some of them are just in the program because they were smart enough to figure it'd be good for their cash flow. And again, these are programs that are put in place specifically to give people enough time to work out whatever situations they might have. And for your listeners who aren't familiar with the terms of the program, the government-backed loans, which is about 60% of the market, you have up to 6 months in forbearance with an option to ask for another 6 months. So that's almost a full year of being in forbearance, and the repayment terms are very, very favorable, in that basically what the lenders have been instructed to do, the servicers have been instructed to do, is take the deferred payments and tack them onto the end of the loan. So those deferred payments aren't due until the loan is refinanced or paid off or the house is sold. So that really gives a lot of these borrowers an awful lot of time to get their financial asses back in order. It gives the economy a little bit of time to recover. And hopefully at the end of that period, a lot of these borrowers will be able to start making the payments that are due.
That is fantastic. And Rick, I am enjoying asking you questions, but I want everyone to know that you all can ask questions too. So this is not just an interview, but a conversation. So in your chat box, if you have questions for Rick, please drop those in and they will come directly to me, and we will make sure that your questions are answered by the one and only Rick Sharga. Sound good to you, Rick? I think that's
Sounds
fun
good.
to have. Yeah, a group roundtable here, right? So jumping back into your discussion here, because this is all so exciting, even with the data that you've shared, and there's still some fluidity, right, in our current state of affairs, admittedly, but there are some key practical things that need to be put in place now. At the end of the day, what's your advice for servicing clients?
Yeah, we do want to get to that. There's one point I forgot to mention, then I'll jump into the servicing question. Homeowners entered this pandemic with a record level of equity. So one of the other reasons I'm somewhat bullish on the market is most people that have been in the industry, and servicers know this very well. What's historically happened is when a borrower got into distress financially, they had enough equity in their house that they were able to execute a sale. And this is an opportunity for the realtors who are on the call today. So they'll sell the house by tapping into their equity. They may sell the house for, excuse me, slightly less than the going market price, but they have enough money to pay off their loan. They get some money in their pocket to start over, and somebody buys a house and gets a pretty good deal. Entering the pandemic, homeowners had $6.5 trillion in equity. It was a record level. And again, the Black Knight survey of the loans in forbearance shows that 91% of the people in forbearance have at least 10% equity, which gives them options if they do have to move rather than risk losing a property to foreclosure. So again, a lot of the data is lined up to suggest that things won't be as bad as some people suggest. Now, there's the question you asked about servicers coming out of this. There's really two parts to this for us to unwrap. One is that, as I mentioned earlier, there's between 4 and 4.5 million people in the forbearance program. Right. They're all going to need to put repayment programs into place at the end of forbearance, whether that forbearance is in 6 months or 12 months, or maybe even a longer term if some of the state governments impose continuing forbearance or moratoria. That means servicers are probably going to be deluged with calls and emails and smoke signals and jets flying banners. from all those borrowers. And I know servicers are trying to do two things right now. They're trying to put in place as much automation as possible to take some of the burden off their employees, and they're trying to hire up. So they have employees ready to go. It's really, really critical that those employees are well trained in time for the forbearance programs to wrap up, because the last thing we need to do is have people calling in and getting to an untrained employee who doesn't really know how to help them, doesn't know the program parameters, makes some mistakes. Servicers are probably still a little bit gun shy from the Great Recession, and being sort of the poster child for everything that went wrong, whether it was their fault or not, because they were the interface with the customer. And that's really, really critical. The other thing servicers do need to be aware of is that, despite my relatively rosy outlook on the market, there's inevitably going to be an increase in default activity. And there are going to be borrowers who need help, whether it's a loan modification, whether it's a deed in lieu, whether it's a short sale, which probably won't be too numerous, or whether it's a different kind of forbearance. So servicers are going to have people knowing what all those options are as well, and ready to help those borrowers either get their loan back in order or exit as gracefully as possible. And so it's a real challenge for servicers, because they're going to have to be ready to pursue those parallel paths, make sure their staffs are trained, make sure they have the technology in place to mitigate some of the difficulty. It's all going to be happening relatively quickly.
Absolutely. And just a quick piece of insight to our folks who are listening. Of course, you may already know this, but VRM has some amazing training resources, folks. So please tap into this ecosystem that we have here for you. But Rick, I know you just mentioned some incredible insight about what's still happening, and it's not going to end tomorrow, right? In a sense.
Sure.
So I do have a question from our listeners here. The first question is, do you think the foreclosure moratorium will continue? And that's a nice dovetail off of your last bit of insight there. Do you think the moratorium will continue?
Yeah, I do. So there's what's missing in the press, and I'm not trying to be critical of the press here, but you just have to kind of dig beneath the surface, is not everybody in the forbearance program is created equal. So there are, as I said, 4.5 million people in the program. About 200,000 of them were in foreclosure before the forbearance program started, and they're in a foreclosure moratorium, so it's a slightly different flavor of forbearance. Some of the states, I'm in California, the California Assembly is kicking around a bill right now that would extend the foreclosure moratoria for another 6 months at the end of the pandemic. So whenever Governor Newsom decides to declare an end to the pandemic in the state, there'd be another 6 months where borrowers would be immune to foreclosure and eviction. So, one of the things to keep in mind is, if you're a servicer, if you're an asset manager, make sure you're working with an attorney firm who is very, very up to date on state laws and can help you navigate through this. But again, before the pandemic hit, we had about 0.5% of all active loans in foreclosure. That's about 200,000. We had another 4% or so that were in some stage of delinquency. So that's another 2 million properties. So 2.2 million properties, as soon as the moratoria expire, will be coming back as delinquencies and as properties in foreclosure. They're, again, all going to hit pretty much at once. And that's not counting the people who entered the forbearance program when they were not delinquent on their loans, when they were current on their loans. So there'll be some fallout there as well.
Right, absolutely. Thank you for sharing that. To this point, we have another audience question. And remember, listeners, please drop questions in your chat box. Our next question is, do you think credit and lending standards will continue to tighten for new buyers?
Yeah, that's a great question. And the answer is, unfortunately, yes, at least in the short term. So what's happening right now is lenders are putting overlays on their loans. They're making it, in English, are making it a little bit harder for borrowers to qualify for loans. And they're not doing it because FHFA or the FHA or the VA have tightened their requirements. They're doing it basically because they're looking to mitigate risk in a very risky lending environment. And the risk is this pandemic and what it's done to the economy. Most economists are forecasting that the US GDP is going to go down between 25 and 40% during the second quarter, which is just unheard of. We've seen 40 million people lose their jobs. So as the economy starts to come back, the numbers are going to look better. But if you happen to be working in an industry that's been particularly hard hit, let's say you work for an airline or a hotel chain, a restaurant, a retailer, lenders want to be sure you're one of the people who's going to have your job at the end of this, and so they are making it a little bit more difficult. They're looking at very high FICO scores. They're looking at decent sized down payments. They're looking at money in the bank. So at least until the economy looks like it's starting to hit on all cylinders, until we see job growth outpacing job losses, I think you're going to see credit standards remain fairly tight for new buyers.
Interesting, interesting. So speaking of credit and those standards, we had another question come in, and they're saying, you know what, let's just talk about that new credit and those reserve requirements. So the writer says most lenders are blaming FHA, but their rules haven't changed. Each lender is hedging their bets actually with those stricter requirements you just outlined, Rick, and not FHA, as so many folks are saying. So essentially they're saying it's important as lenders previously approved folks for loans and recanted based on their rules and not the FHA rules, but yet then blamed the system during COVID. What's your response to this?
Imagine blaming somebody else for your own actions. Whoever thought of something like that?
I know, novel idea.
Yeah, like the novel virus. So no, it is not FHA. No matter what you're hearing, it's not FHA, it's not VA, it's not USDA, it's not Fannie, it's not Freddie. They're still they have not tightened their credit box to my knowledge at all. Lenders in some cases are focusing more on refi activity because refi loans tend to be a little bit easier, sometimes can be a little bit more profitable. And in some cases, you might be hearing excuses from lenders that are really just giving them kind of some cover to go do something they'd rather do. And it's a short-term mentality. So, look around. Lenders, you get different deals from different lenders. You have some that are more willing to, a little bit hungrier, maybe more willing to work with you. And don't, if you hear somebody giving you that answer, it's probably a good time to move over to another lender.
Awesome, awesome, awesome. Thank you for addressing that. So we have so many questions coming into the chat box. Let's just go all chat box right now, Rick, and then we'll land the plane in just a few minutes. So do you think the commercial market will follow the residential market, or do you think there will be more commercial defaults?
One of my favorite questions, actually. I'm more concerned this time with the commercial market than I am with the residential market.
Interesting.
Been so much activity aimed at the residential market and propping up home ownership to try and make sure people don't lose their homes. And there's obviously a lot of emotion attached to that. We're not seeing the same sort of thing on the commercial side. I'm particularly concerned about the hospitality and retail sectors of commercial. We had a lot of retailers that were kind of unsteady to begin with and may have had the stilts knocked out from under them during COVID. I think we've seen 3 different fitness companies, for example, most recently 24 Hour Fitness, declare bankruptcy and start closing locations. A lot of retailers, JCPenney, probably one of the bigger ones, but Neiman Marcus on the other end of the spectrum, and a lot of household names that are not big box stores, but have a lot of brick and mortar across the country. So I do think there's going to be some carnage in retail. I'm concerned about the segment of hospitality that's called limited service hotels. I'm not terribly concerned about Hyatt and Marriott. I think they'll weather the storm because they're big and they can throw a lot of capital at the problem. But those limited service hotels I know tend to be owned by small investors who may just not have the cash to get through this period of time. And then longer term, I think you have some fundamental issues going on with offices. I think you'll start to see a more decentralized workforce and kind companies have to be wondering why they're paying tens of millions of dollars a year for big corporate headquarters when everybody's more productive working from home. So you'll see some changes. The one thing people need to keep in mind about commercial foreclosures or commercial default is that typically a lot of those situations get resolved prior to foreclosure. So somebody will sell off at a loss, they'll sell in distress, but they won't necessarily wind up going through the whole foreclosure process. So commercial is prone to a lot more deal making. Where there might be opportunities, I would think would be in the small dollar commercial, the 1 to 4 apartment dwellings, the local gas station or Del Taco or whatever. That whose owner might have fallen on hard times financially, but definitely watch the commercial market.
Interesting. That was so good. Thank you for that. Question from the chat box. Are you expecting a surge in short sales?
No, I'm not. And the reason for that is what I talked about before. The homeowners entering this pandemic had record levels of equity, which means their houses are worth more than they owe on their mortgage. If this were the Great Recession, where we had 30% of homeowners underwater on their loans, then you can expect more short sales. So we may see a very, very modest uptick in a handful of geographies, but no matter whose data you look at, the number of borrowers who are underwater on their loans is down in the single digits now. And home prices, by the way, continue to go up, so that equity number improves. I did want to kind of circle back. That question reminded me of something that you and I talked about in preparing. I do expect the number of defaults to go up. I don't want anybody to think I'm completely insane. I have a teenage daughter who thinks that already, so I don't need anybody else.
Nobody else but the teenagers, folks.
Amen. But we entered this with about 0.5% of borrowers in foreclosure. That's about half of the normal historic rate. If you took all of the people that are below 10% equity in the forbearance program and threw them into foreclosure, you'd more or less double that number. So you'd be up a little bit over a point, maybe up to 1.5 points. So I do think we'll see a higher level of default, but you have to keep in mind most of the people losing their jobs so far have been renters, not homeowners. And so both the current homeowners and the pool of potential homeowners are not being impacted nearly as much by the downturn as renters are. And I do believe that will keep a lot of people out of foreclosure, but we'll see an uplift and people need to be ready for that.
Absolutely. I'm so glad you went back to that point, Rick, that you and I unpacked together. Let's do another chat box. And by the way, listeners, if you have a question for Rick Sharga, please drop it in your chat box. For most of us, it should be to the right of your screen, and we will make sure that you are part of this conversation on FinServ Now. Rick, chat box question. Do you foresee deflation?
That's a really good question. There are about a half dozen economists I communicate with regularly that I respect, and I think about a third of them are concerned about deflation. About a third are concerned about inflation, and a third are kind of like me, where they really don't know, and are just admitting that. The Fed is printing a ton of money, which does tend to devalue the dollar, and could conceivably lead to deflation. But we're in such unusual times right now. We've never seen this kind of stimulus injected into the economy by the government. We've never seen this much money printed. We've never seen the Fed get as active in the kind of things that it's buying to prop up the market. So could we head into deflationary times? We could, but it's far, far from a certainty, and I think it's still probably unlikely.
Okay, very interesting, very interesting. So guys, I want to give you an inside track. Rick and I had a conversation before this one with you, as he alluded to when we prepped, and something you shared with me, Rick, gave me chills, and it was almost a call to action for servicers to rise up. Here's what I mean. You illuminated that our servicers are so critical, and not just because they keep things going, but you assert that if they're not equipped and if they're not ready, the client could go into foreclosure. There's a one-to-one correlation here. This is a big mantle to uphold. Can you unpack that a bit for us?
Yeah, it's actually even more multi-tiered than that. And you and I talked about this a little bit yesterday.
Mm-hmm.
Um, there was a concern when the forbearance program was announced that servicers would be on the hook for way too much money. And trust me, I'm circling back to our conversation. Um, if 25% of borrowers had opted into forbearance, servicers would have been on the hook, using my back of the envelope math, for about $90 billion over the next 6 months. And that would have effectively bankrupt the servicing industry, and made it impossible for anybody to get a loan. So servicers
Right.
are kind of an underappreciated and very often unrecognized linchpin in keeping the whole lending mechanism moving. I apologize for anybody who's an engineer who's listening. I just really botched that metaphor terribly. Um, a linchpin probably wouldn't keep the engine moving. Anyway, um, we're coming to another critical juncture, which is the end of these forbearance programs. And the government programs are going to be difficult enough. You're going to have millions of borrowers coming in with these government-backed loans, looking for repayment programs, looking to restart their payments. And if servicers aren't ready for that volume, we could have utter chaos. And you could wind up inadvertently throwing people into foreclosure who aren't supposed to be there.
Wow.
There could be all sorts of chaos. The more compelling problem is that 40% of loans out there are not government backed. So they're on the books of portfolio lenders, banks, other investment funds that own these loans. They're not necessarily required to use exactly the same processes as government backed loans are, servicers are. And my concern, and this is only a concern because the industry has had an uncanny knack for doing exactly the wrong thing at the wrong time over the centuries. And a forbearance program historically is resolved by asking for a lump sum payment at the end of the forbearance. Imagine somebody being out of work for 6 months on what's probably a high dollar loan, and the servicer saying, "Great, the forbearance program is over. You now owe me a lump sum payment for 7 months of your mortgage."
Right.
The technical term I use for that is guaranteed foreclosure.
Hmm.
So if the industry doesn't do the right thing, if the industry isn't prepared, if the industry doesn't look through this with a very logical, dispassionate approach, we could artificially create a flood of foreclosures where one didn't need to exist.
Mm-hmm.
That will hurt not just those borrowers, but it will also hurt the housing market, which contributes about 17 to 18% of the US economy. So by doing the wrong thing, and if we're not really ready to handle this inflow, servicers could disrupt the lending industry, the housing industry, and the US economy. And it's really, really critical that everybody knows the degree of importance that their job entails, and how important it is to everybody's well-being that they get through this as well as possible.
Gotcha. Absolutely. Thank you for that. So, what do you think a second wave of COVID will do to the economy? Now that you've shared all of this, let's get to it, right? This is a
Yeah.
great
So,
chat
so,
box
yeah, so what
question.
else could possibly go wrong, right? And we seem to have at least dodged the killer hornets for the time being, so that's a good
For the
thing.
time being, didn't that story kind of disappear?
Although I still expect perhaps from Central America to see a wave of poisonous frogs attack, but
Why not? At this point.
it's 2020, right? Why not?
Yeah, there you go.
So really good questions, and one that's kind of out of my beyond my pay grade. If we have a worse wave of COVID-19 than the first wave, it could conceivably shut down the economy, whether the government does it or not. So one of the things that
Mm.
anecdotally we're hearing as local economies reopen is that while business is improving, it's certainly nowhere near where it was before the pandemic. So there, people are reluctant to get on planes. They're reluctant to go into group settings. They're to a certain extent reluctant to go to restaurants. So there will be a consumer reluctance that will be exacerbated if we have a really strong second wave. What's happening right now seems to be the end of the first wave. So some of the states that sort of escaped the virus a few months ago seem to be kind of getting their version of wave one right now. We do know there's a couple promising vaccines in the labs right now. The European Union has signed up for 400 million doses of one from one of the pharmaceutical companies. There's some Italian research out that suggests the virus is mutating, but it's mutating to a weaker form. And it looks like we are starting to put, more rigorous social distancing and safety practices into place across the country, which, would have a mitigating effect on the worst of the worst. But, keep in mind that the Spanish flu, which was the last time we had a pandemic like this, and it was much more deadly than COVID, by the way. But the second wave of the Spanish flu wiped out far more Americans than the first wave did. I think because there was a bit of a cavalier attitude, we got through the first wave, how bad can it be? So if this gets shut down again, and if the government doesn't come riding into the rescue with trillions of dollars, all bets are off. But it's hard to predict a catastrophe, and it's even harder to predict the results of the catastrophe until it happens.
Right. Yeah. Yeah. Absolutely. But thank you for that insight, though, from your purview. We have one more chat box question, and then we will land the plane here, Rick. And this is going back to something you touched on earlier, in a sense, if the GDP drops, won't that increase unemployment? And so I guess part of the fear there is still the sort of trickle across effect. I won't say trickle down, but if the GDP drops, won't that increase unemployment?
Not necessarily, although GDP numbers and employment numbers tend to be very similar. They tend to run in the same direction. But, the GDP growth was slowing down before the pandemic. It was still positive, but it was slower. And job growth was actually continuing at a very robust pace, as were wages, by the way. The reality is that as job growth improves, the GDP will improve. So it's almost like you have to look at it backwards from the way the question was asked. The US economy is based 65 to 70% on consumer spending. When you send all the consumers home and shut all the places where they usually spend their money, there's really nowhere for the GDP to go but down. So nobody should have been surprised when we saw Q1 go down. Nobody should be surprised when we see horrific numbers reported for Q2. But as economies open up, people are getting their jobs back. Consumers are starting to spend more money. We saw an almost 18% lift in retail sales a month ago. And that will lift the GDP. So I don't expect the GDP. I think what we're seeing in terms of unemployment numbers through the second quarter is the reason we're going to see the enormous drop in the GDP, not the other way around. So we're the dependency is kind of a little bit backwards. And numbers can be a little bit confusing like that. One of the things you and I talked about that I think the attendees are probably interested in is delinquency numbers. And that's a question we get pretty frequently since we're talking about confusing numbers.
Right.
People wonder how I can look at delinquency numbers doubling and almost tripling since the pandemic started and not think we're going to have more foreclosures. Well, as I said, we will have somewhat more foreclosures, but keep in mind that the delinquency numbers we're seeing right now are tied directly into the forbearance programs. It's a one-to-one correlation between number of loans in forbearance and number of loans that are listed as delinquent. And if this all works out the way it's supposed to work out, the majority of those loans won't be delinquent at the end of the forbearance program. So, people you really do need to kind of dig below the surface of some of these numbers in order to understand some of the relationships.
That is so powerful. Thank you so much, Rick. And thank you so much to our audience for dropping your questions into the chat box. And if there are no other chat box questions, Rick, I think this is a perfect opportunity for you to just give us your closing thought. If there is one, or if there are even two nuggets that you want folks to take away as they go back to their everyday lives and into this new normal, what would you send them away with?
I would say that it's important not to get overwhelmed by the numbers that you're going to see. The numbers are every bit as bad as what they appear to be, but they are also understandable and they are also to be expected. And they're also very likely to reverse themselves, not necessarily in a V-shaped recovery, which we would all love to see, but in a steady, perhaps more gradual recovery. And I believe also that the housing market is one of the best hopes for the overall economy to recover, because again, housing has tended to lead the economy out of recessions, every recession since World War II, really, except for the last one, which, by the way, was caused by the housing industry. So there is hope, and for those who are focused mostly on the default servicing part of the business, expect your numbers to come up. Be prepared for that. Let's make sure we don't repeat the mistakes that we made during the Great Recession, and make sure we're ready to help borrowers get on with their journey as painlessly and efficiently as possible. And we will get through this together.
Yes, we will, Rick. Thank you so much, guys. The one and only Rick Sharga. And please remember, this series, even though this is our first episode, we have more coming. So we will be broadcasting the third Tuesday of every month at 1 p.m. Central. And CIF members get some increased benefits, and you will be getting details about that very, very soon. Increased benefits on top of all of this. What does that mean? Yeah, wait till you see these emails. So I'm excited. And guys, please make sure you sign up at counselforinclusion.org/FinServ-now so that you can be able to still ask folks like Rick Sharga questions one-to-one like this. Rick, I appreciate your time so much. Thank you for this.
Thank you so much for inviting me in, and good luck with the rest of the series.
Thank you so much, guys. This has been FinServ Now with Zakiya Larry. I will talk to you next month.